Morning, everybody. It's Max. How's everyone doing today? Hope everyone's having a good day. It's kind of Indian summer here in Austin. The grass is turning green again. It's warming up again this week. Last week was kind of cold and blustery, but we still didn't get a freeze. All right. Good news. Tasty Trade brought its back testing back. I'm obsessed with back testing. I've had a lot of content in the past on backtesting. It's really not backtesting that I'm obsessed with, but you can use backtest. I can use backtest to illustrate how funds are making money or what they're doing right or what they're doing wrong. And we can go back and look at scenarios in history, and we can look at different strategies, and we can see how that strategy or that fund would have done. Anyway, I like that kind of content. I don't think anyone else is doing that kind of content. I'm kind of more interested in the inner workings of these funds and doing the same thing the funds are doing myself. That's more what my niche is. Anyway, all right, let's talk about ULTY, because for people that don't care about trading options or whatever, if you understand how options work, but you don't want to dick with it, and you have a high risk tolerance, ULTY's is a fund that might work for you. If you have a low risk tolerance, there's other funds that could work also. So it's all good. All right, well, let's look at ULTY first. But I always start with ULTY because they change their positions every day. So to me, it's the ULTYverse is the most interesting. Well, here's the ULTYverse today. Okay, unfortunately, ULTY itself is down a percentage point, but the average of all the stocks in the universe are down a little bit more, but still kind of a rough day for ULTY today. BABA's up. mRNA's up, but a lot of stocks are not up this morning. In fact, Kava's down 10%, Mara's down 7%, Coin's down 7%. So let's look at the ULTY grid real quick. Now, the ULTY grid, the iron condor that they had on in Internet of Things, I think that's what that stock is called. I mean, it's called something else too. I always call it IoT, Internet of Things, but it's called Samsara or something. Anyway, they had an iron condor and now they're out. So Jay probably watched my show and heard me remark that I don't like iron condors. And so that's why he took it out of the portfolio. You know, they don't want to do anything that gets them sideways with Max Convexity's audience. All right. So other than that, the only other change is SMR, the nuclear company. They're out. They had a caller on and they're out. Other than that, all the stuff that was on the other day, all the colors that are on the other day are still on today. So I'm going to say here is the chart of the ULTYverse. So we'll keep an eye on that. All right, now let's look at the single stock, or let's look at the index buffer report. All right, on SPY, it's really not, SPY's down a little bit, but it's really probably not statistically significant. Now, NASDAQ's pulling back a little bit more, so it probably does matter that KQQQ is pulling back a little harder than NASDAQ. That happens sometimes. Triple QT is down about as much as NASDAQ, as is QDTE. The one that's actually doing the best, and it's probably this way almost every day, YieldMax'er. JEPQ looks good also. Now, in Russell land, we aren't going to look at Russell. USOY's up today. That's good news or USO's up today, which is good news for the Defiance Fund, USOY. Maxie's pulling back. All right. So let's see what else we can get ourselves in the middle of. Let's look at see what's going on with the market. All right. Well, the market, let's talk about the market really fast. I usually lead with the market, but I didn't today because it was a more detailed explanation. Today, between Tuesday and Wednesday of last week, we had a big gap, and it was a gap over an all-time high. That's called a breakaway gap, but anyway, it doesn't matter. So I put it. So gaps are information. We also have a gap back here, a bearish gap that failed. It got filled. That's why I put it red. But then before that, we have a gigantic bullish gap from the night of the election, from election night. All right, gaps are bullish as long as they hold. A bullish gap is bullish as long as they hold. So from an order flow perspective, this morning's price sold off into this gap the other day. They do that sometimes to check and see if buyers are still there. Now, so far, people bought it, and but especially by the end of the day, if by the end of the day we're underneath this, and especially if we close on our lows outside of Bollinger Bands, this gap is filled, obviously, and probably next stop would be this gap. Okay. But now that information can change every morning. We could do that for a few days. Then like between Tuesday and Wednesday, there could be another gigantic bullish gap. Well, then we would put the bullish gap on our chart and we would just carry the information forward. We just carry our narrative forward. But right now we're bullish, and we're especially bullish as long as this gap holds. If we get underneath this gap, we're still bullish, but we're looking for a pullback to this area. All right. And then we get underneath this gap, there's probably other open gaps down there. There's other things you can look at. Gaps aren't the only thing to look at, but it's one of the main things to look at because of the fact that the indexes don't trade 24 hours. So you get as much information almost by where it hasn't traded as where it has. All right. So it looks like the next major area, if this gap right here fails, which we don't have any reason to think it will. I mean, the gap above it's holding as of right now. But if this gap fails, then we would look for 53.7. So where this can help us is for setting option trades. So lots of times in an option trade, you have to, or it's good to aim for an area. We can use these gaps as areas to aim for. If this gap fails, like we could put on an option trade that aims for a price of next week, say next Wednesday at 58.50 or whatever. We could aim for that gap. We could put something on that goes for it. Anyway, it's important information to have. So right now we're cautiously optimistic. All right, let's see how the Qs are doing. All right, so the Qs, I haven't drawn their gap on here, but their election night gap is still open. So it's that's supporting the market. And they have a bullish gap right here that they're still well above. All right. But if the market sold off into that area, that's where the first place we might look for support. And if that fails, we would look down here for the next gap, which is around the 490 level. All right. Well, that's a quick lesson on gaps. Earnings strategies. I showed you guys how to do something called a bunt, what I'm calling a bunt. But it's an earnings strategy. We'll look at Oracle. Now, on this strategy, it's 2 calendar spreads, but on this strategy, it's called a double calendar, double diagonal. We're aiming for this ghost-looking thing is a probability cone. The most likely place for the stock to end up is between these first 2 hash marks. That's the one standard deviation area. It ends up in that area. It's like 70. Let's see, 83. It's 83 less 14. 69. It ends up in that. That's right. About 2/3 of the time, a little bit more than 2/3 of the time, at one standard deviation. All right. So if we get a 1 standard deviation move down, meaning a 5 or 10% move down in the stock price, this targets a profit of 400 or 500. Same thing. If we get a small move, 5-10% up, which is what they kind of expect, you could profit anywhere between $400 and $700. All right, so that's the double diagonal. Now, that's called a bunt because you aren't going for extra bases there. This is a high percentage. Look at that chance of profit, 94%. Look at this. We could look at the theta. That's how much. You make $74 off this trade today, mathematically. That's how much in 24-hour time you would mathematically expect to earn in time decay off this spread. Okay. So now that's a bunch. So Oracle has earnings after the bell. So wonder if somebody was wildly bullish on Oracle. Well, we have that one in here too. This one's called a hit and run. All right, this one's a combination of 3 options, 2 puts, 1 call. I'll post it to the comments. Get a $208 credit for putting it on. It ties up about $1,800. So you get a little bit more than 10% of your money back immediately, and you get to hold on to that money as long as the stock doesn't drop more than as long as Oracle doesn't drop more than 5.2% between now and the end of the week. If they have a good earnings announcement, or if they have kind of a bad earnings announcement, the stock just doesn't go anywhere, but it doesn't drop more than 5%, then that works. You get to hang on the $200. If this is a case like Lululemon was last week, where they blew out earnings that went up 30%, you're on board for that too. You still get to keep this $200, but a 30% move would make you about $3,500 extra. Your $200 is already in that price, so you're keeping the $200, and then you could sell this for $30. You could sell it right there. Put it on a $4,000. You could sell that for about $3,800 right there. Plus, you have 2 in your pocket, so your total profit of the trade is $4,000. The other thing is on these trades, you may not hold it till expiration. If you hold it just about halfway to expiration, which is what a lot of people do, you have a pretty good. So you could hold this. This is Saturday, December 14th, Monday the 16th. So you could hold this trade until, let's just say you hold it till Friday. Yeah, you hold it till Friday. Okay. Well, you can see it's basically a similar return profile to stock, but you have some convexity if you get a move up here. In other words, the slope of the curve increases. That's what convexity looks like, where it's convex instead of concave. You don't want a concave profile. All right, I'll save in case anyone wants to do that trade. Like I say, it ties up $1,800. You get $200 back right away if you get the same price as I do. Now, I did this on positions. You could see I put in $1 a contract. That's what Tasty Trade charges. And I put the bid ask. If you check bid ask instead of midpoint, it gives you a bad fill. But that's good. We want a bad fill when we're trying to simulate a trade. We want to get filled at the worst prices, because if we can make the math work at the bad prices, if we say, okay, that looks good, then we're going to go in there with our limit order and try to do a little better. Of course, we aren't going to just take the bad offer. We're going to try to get, between the bid and the ask. But on all of these stocks, especially like Oracle, they have earnings today. They have 112 open contracts, 193 volume on this. So you should have no problem buying a 5 lot or whatever. This one, look at this. They have 2,000 contracts with 1,000 volume. I mean, so it'd be easy to put this trade on. Look at the bid-ask spread. It's only 11 cents. And we're just assuming we get the worst. We pay this one's 10 cents spread. That one's 11 cents. And this spread right here is 9 cents. So we're just assuming that our fill is 30 cents worse than it might have to be. Meaning $30 worth. So this credit's only $208. But we really should have got $238, and or even like $228 if we could get filled between the bid and the ask. Well, the difference between $208 and $228 may not seem like a lot, but over time it damn sure is a lot. It's an extra 10%. So anyway, but when I simulate these trades, I simulate them with the worst fill possible. Sometimes you may get into Tasty Trade and you may not be able to do this. The market makers won't give you the trade that you can put on in option strat. And that happens sometimes. But if you stick with the stocks that I'm talking about, which are earning stocks, which have tons of volatility and high IV, you can generally, it's been my experience, you can generally get trades like this on. But anyway, so that's our earnings hit and run. If Oracle's up 20%, after earnings, it's a $1,700 winner. Even if it's up 15%, it's a $1,300 winner. That's even if we don't hold it till expiration. At expiration, it could be worth a little more. But anyway, so I will definitely save that in the comments in case anyone wants to look at that and try to get something similar on in your own brokerage house, but you make 10%. You just don't want the stock to drop more than 5% in a week, and you get to hang on to the 10%. Plus you have a lotto ticket for a little bit of extra upside. All right, so I also showed you guys Bunt and MongoDB, a Bunt and AI. They also have earnings after the bell. We don't have any hit and runs on in there. I'll probably go simulate them and save them in here just so we can see how they would have done. I'm trying to compare the bunts and the hit and runs. I think there's sometimes certain circumstances where you could do it together and almost lock in a profit, where you have a bunt on and a hit and run. Anyway, but I'm trying to get I'm trying to get enough information to make content on that and to either prove that or disprove it. But the tasty backtester is really helpful also. So be expecting some content on the backtester. Look at this. Wouldn't you guys like to know what this strategy is? This right here is a four-legged strategy. It's a double diagonal. I'll just tell you what it is. So it's the same type of trade I showed you for earnings just now, but this is something you could put on every day in the queues. And this is over the past 5 years. This is since 2019. So this includes 2020 and 2022, which were shitty times for the market. I didn't cherry pick the thing. This strategy still has 75% profit. Average return per trade's 2%. Average days in the trade, 3 days. But here's the most important part. Average premium. You make $243 a day with this strategy. And you get that much in income. Now, it turns into profit if you're able to hang on to it. So right here's average profit or loss per trade. And you're hanging on to about 15% of it. But this strategy makes about $250 a day. Over the past 5 years, it's made $300,000. That's $60,000 a year. That replaces a middle-class full-time job. That replaces a cop salary or a teacher salary. So the worst things can happen. Anyway, this is a good this is an interesting strategy. I'll be expecting some more content on things like this soon, but we could even go down to the individual trades. We can go down. Yeah, I could show you guys a strategy, and then we can look at how it would have performed in March 2020. This one did not do great. This one, it can't predict everything. This one's more of a steady market strategy, not so much a crash strategy. But let's just see how it did do during the crash. Okay, so here we go. February. So we're rolling along. And here's how much, this column's how much income it brings in. 307, we got to keep all of it and then some. 350, we got to hang on to half of it. We brought in 70, we got to hang on to all of it plus 20 more. 79, got to hang on to all of it plus 20 more. Now this day we lost, we paid, probably because the IV got jacked overnight. Yeah, this is February 12th. So we paid to put this spread on, which we wouldn't have done in real life. We would have adjusted the wings to make it a credit trade. But anyway, the simulator doesn't know that. It still made money on that one. But then the next day we brought in $322 credit, lost $400. Next day made $180. This was a really good day. Brought in $40 credit, made $180. But then the shit hits the fan. Then we have February 19th. Lose $600. We lose $900. Lose $900. Lose $800. Make $140. Lose $400. But then on the other side, when the market starts going up again, we start doing all right, make 5, 6, 3, 4, 9, but then the market takes another dip down and we lose $5,000 over 2 days. Well, anyway, but then you can see on the backside of it, when we hit March, it just turned into, look at this, 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 days in a row. And then we're just killing it here. Look how many days in a row there. And all you're doing is selling 4 options. You don't even have stock. But you're selling 2 options and buying 2 options. It's double diagonal. You don't have stock, but you're outperforming stock. Total, if you just bought and hold the stock for 5 years, you'd be at 36,000. If you'd done this trading strategy, you'd be at 49,000. And it's about a 200% return on capital. So anyway, be expecting some content on that. But I've been writing scripts all weekend for this type of content. Anyway, so hopefully you guys like that type of content. Let's see what else. So just check in on some of our trades from last week. The bullish in Soundhound worked out. The bunt and Ulta worked out. The bunt and Lululemon worked out. The bunt and DocuSign did not work out. Now here we have a loaded dice trade, which is called a hit and run. Anyway, for Etsy for the end of the month. This doesn't expire till December 27th. This is just a play on the Santa Claus rally. I just thought this would be fun. Right now it's up $1. Let's just check in on it. So it's a double diagonal. Similar, it's actually not double diagonal. This is a risk reversal. But anyway, it's an interesting trade. If we do get a Santa Claus rally, Etsy's retail, and wonder if Etsy rips into the end of the year. I think I saw a story about Etsy or something. That's what this trade is. This trade's an attempt to make $600-700 if Etsy rips. But you get a buffer and you get an income as long as Etsy doesn't drop. So I like those kind of trades. That's a risk reversal, otherwise known as a hit and run. All right, guys. Well, that's enough content for today. I appreciate you all for being here. I will be back later this afternoon. That's unless I get stuck in that back tester, and then I did it last night till 3 a.m. It takes a long time to discover those strategies. That strategy I discovered is pretty good. Be expecting some content on it soon. That's the kind of stuff I'm interested in. Is how to use options and do better than stock with less risk or with similar risk. All right, guys. I appreciate you. Thank you for being here.